So you're doing on interest method of accounting for hire purchase. Doing question number 2 of the handout, page 12. Handout, page 12. So, and you're told that Corporation Limited has been in business for several years, dealing in electronic goods. All goods are sold on hire purchase terms. And the following trial balance was extracted from the books of the firm as at that 1st of March 2016. So we have the ordinary share capital, cash at bank and in hand. We have account payable, operating expenses, PPE, depreciation, hire purchase installment receivable. Those are debtors. We have the hire purchase sales. We have the purchases. We have inventory as at 1st of April 2015. Those are the opening stock. Additional information. Inventory as at that 1st of March 2016 was valued as 2.4 million. Now those are the closing stock. Then number 2, PPE should be depreciated at 5 million for the year ended that 1st of March 2016. Number 3, each unit was sold on hire purchase basis on the following terms. Cash price is 40, then you pay a deposit of 10, interest of 6. So therefore, how much is our hire purchase price? How much is the hire purchase price? The amount of 46, correct. You see that hire purchase price, you take the cash price, you add the interest. And in this case, the cash price was 40, and then it attracts an interest of 6,000. So that means the hire purchase price is 46. Now note that when accounting using the interest method, there is something we said that sales will be recognized at cash price, then interest will be computed separately and recognized as an income. So that means for every item they sell, the income per one asset is 6,000. Now this is the interest. So this interest you compute it separately and then you recognize it as an income. Then I give you 3 methods you can use to allocate this interest. One was the second method, sum of digit method or actuarial method. Number 4, assume that all the sales are made at the end of each quarter, and the quarter ends on that 1st of March, June, September, and December. March, June, September, and December. Those are the 4 quarters. First quarter, second quarter, third quarter, and fourth quarter. So do that. Assume that all sales are made at the end of each quarter, and the quarter ends on that 1st of March, June, September, December, respectively. The balance due on each hire purchase sales is payable in 4 equal installments of 9,000 per quarter, payable at the end of each quarter, and commencing in the quarter following that which the sales were made. We read again. The second sentence of note number 4. The balance due on hire purchase sales is payable in 4 equal installments. So we pay in 4 equal installments of 9,000 per quarter, payable at the end of each quarter. So it'll be paid at the end of each quarter, but commencing in the quarter following that which the sales were made. What does that mean? So that means the sales we made on the first quarter, the first payment will be received from the beginning of the second quarter, following that quarter of sales. So that means the first installment for the first, the first payment we made, the first installment will be received here in June. The second installment, the third installment, the fourth installment will be received next year. Then the sales made for the second quarter, this was the second, these are the quarters. Now, the sales made at the second quarter, the first installment will be received from the following quarter. So here we receive the first installment, second installment, third installment, fourth installment. The same we made at the end of the third quarter, the first installment will be received from the December quarter, second installment, third installment, fourth installment. The same that we made at the fourth quarter, the first installment now will be received from the first quarter of the following financial year. Explain everything. The number of units sold during each quarter was follows. So we are given the number of units sold. So quarter 1, quarter 2, quarter 3, quarter 4. Quarter 1 we sold 1,000 units. Here we sold 200 units. Here we sold 300 units. Here we sold 600 units. Now, objective is to determine how much was the interest income. For each unit, the interest is 6,000. So you multiply by 6,000 per unit. So that means the sales for the first quarter, we made a total interest of 600,000, 1,200, 1,800, and we got an amount of 36. All installments were received on their due dates. Number 5. The sum of digit method is to be used to apportion the interest. So we have to use the sum of digit to apportion the interest. The appropriate amount being credited in the quarter in which the installment was received. So we have to allocate this interest using the sum of digit. And how do we account using the sum of digit? So the installment payment is 4 quarters. So we take 1 plus 2 plus 3 plus 4. We call it the sum of digit. Method of allocation. So it's 1 plus 2 plus 3 plus 4. You get 10. So how do we allocate? So we start with the sales of the first quarter. Now we see the total interest earned from the sale of first quarter is 600, but the customer will pay in the next 4 installments. So the question is, the first installment, how much will you recognize as an interest? The second installment, the third, and the fourth. So first installment, first, second, third, and fourth. So these are the sum of digit works. Now the sale for quarter 1, we will take 4 over 10, 3 over 10, 2 over 10, 1 over 10. Then we are portioning this interest of 600. 40%, that's 240. That's 180. 20% is 120. You'll get an amount of 60. What about the interest earned from the sales of the second quarter? Second quarter, we made a total interest of 1,200. So how do we apportion? Now the first installment, you'll take 4 over 10, 3 over 10, 2 over 10, 1 over 10. And here we made a total of 1,200. To 40, that's 480. That's 360. 20%, that's 240. Here we have 120. What about the interest earned from the sale of the third quarter? We made a total interest of 1.8 million. So how do we allocate 1.8? So for the first installment, you take 4 over 10, second 3 over 10, 2 over 10, 1 over 10. And then we are allocating this 1.8. So how much is that? So this is 540. 20%, that's 360. This one is 180. What about for the fourth quarter? The sales for the fourth quarter, we earned a total interest of 3.6. So for the first installment, it will be 4 over 10, 3 over 10, 4 over 10, 1 over 10. And then we are allocating 3.6. How much is that? How much is this? $360. So now, that's how now you're supposed to recognize the interest from the first installment, second, third, fourth. But now we want to determine how much interest, what we call the realized interest, for the year we really recognize. So we determine now interest for the year, which will be recognized as an income. Sales for quarter 1, quarter 2, quarter 3, quarter 4, and these are the same of the installment from quarter 1, quarter 2, quarter 3, quarter 4. And then you get a reason here. There is something I was explaining on how the sales for the first quarter, the payment will be received, the first installment will be received at the end of the quarter following that or commencing that of sale. So that means the sales for the first quarter, the first installment will be received from the second quarter. So that means, now this is the interest for the first quarter. The first installment will receive 240, second installment 180, third 120, 460. But you're saying that the sales for the first quarter, the first installment received from the second quarter, and the first installment will be 240, second installment 180, third installment 120. Then this for the fourth one will be received from the first quarter of the coming year. That will not be recognized during this year. The sales for the second quarter, the first installment is received now from the third quarter. And the first installment will be 480. From the second quarter, this is the second quarter, but the first installment received commencing on the month, commencing on the quarter following that of sale. So here you have 480. The second installment 360. Now 240, 120 will go to the next financial year. The sales for the third quarter, the first installment will be received now from the fourth quarter. From quarter 3, the first installment will be 720. Then all the remaining 3 installments now will go to the next financial year. The sales made at the fourth quarter, the first installment will be received the first quarter of the next financial year. So now this is the interest which will be recognized during the year. How much is the total? Number six. Included in the operating expense is the lease rentals of 2 million paid at the commencement of the financial year. This relate to an equipment whose fair value is 8 million. We say that the fair value is the same as the amortized value or the present value of the future cash flow or lease rentals not paid at the commencement. So this relate to an equipment whose fair value is 8 million. The payment has been treated as an operating risk, whereas it's a finance risk. The duration of the lease is 5 years, and the interest is 10% per annum. Lease rentals are paid in advance. So here we have a risk, so that means we need to amortize this risk. And this risk we are paying in advance. So if you have a risk, now that means we as the company, we are the receipt. So how do we account as the receipt? Now, as the receipt number one, you need to recognize lease liability. And you see that lease liability is the same as the present value of the future cash flow not received at the commencement. Yeah, I gave you on how to compute it, but in this case, we can just use the fair value. You know that which had a fair value of 8 million. Because even if we compute, you get the present value. How much are we paying each month, each year? How much is the lease rental per annum? So the lease rental per annum is 2 million for a period of 5 years, but we are paying in advance. So if you were to discount that, this is what we are doing in our last topic about the lease rentals. So we'll still go back to 8. So in this case, the lease liability to recognize will be 8 million. We don't have to discount. Then the other item we need to recognize is the right of use asset. So that to get the right of use asset, you will take the lease liability, which is still 8,000. Then you add what? The payment made at the beginning, as well as you add what? Any initial direct costs. Since we remember nothing. So let me repeat again. So the first step when accounting for it, you determine the lease liability, and we say that the lease liability is the present value of lease rentals not paid at the commencement. Now, our lease rental per year is 2 million. Present value interest factor of annuity. The cost of capital is 10% for a period of how many years? 4 years. So it will be 2,000 times 1 minus 1 plus R, 0.1, raised power negative 4, 0.1. So what do you get? You get 6340. Then, now let's determine the right of use asset. Now, for the right of use asset, say that you'll take the lease liability, which is 6340. Then we said you add any payment made in advance. And you see, in this case, we're saying that we are paying our lease rentals in advance, of which the lease rental is 2 million. Then you add any initial direct cost, which is 0. So you get a total of 8340. So there I got an answer that it was supposed to be 5. Yeah, because you are really willing to give me 5. Let me explain why it's not 5. Now, you see, in this case, the lease is for 5 years, of which we'll be paying 2 million, 2 million, but now we are paying at the commencement, right together. So that means when you entered into contract, initially you paid an amount of the first 2. And lease liability, remember the definition of lease liability is that is the present value of lease rentals not paid at the commencement. So this one we are paying in advance. So that means when you enter into contract, you paid 2 million. Now, the balance is what now we call a liability, what you have not yet paid. So here you paid 2 million at the commencement. So what you have not paid is these 2 for the remaining 4 years. That's the liability. And that's why determining the right of use asset, you have taken the lease liability for 4 years as what you had paid in advance. You had already paid 2. In case we are paying in arrears, that's when you could have discounted for the entire 5 years, since you are paying at the end. Good. Now, once you have the right of use asset, you depreciate the right of use asset. So depreciation per annum will be 8340. You depreciate for 5 years. 1660? 1668, good. Then from there, we prepare a lease amortization schedule. Now here I want you to reason. The lease was for 5 years, but in this case, you don't have to prepare for 4 years because our objective here, you're not accounting for this. Our objective is to prepare the financial statement for this company for this financial year. So you don't have to prepare for the 5 years. You only need to prepare for 2 years. Whenever the objective is to prepare the financial statement, don't prepare the lease amortization schedule for all the 5 years or the lease period. No, you only prepare for only 2 years. Year 1, year 2. Balance brought down. Then we start with payment. We are paying in advance so that we get our balance due. Now, the balance due is what now will accrue the interest at the rate of 10%. And that's now how we get the balance carried down. The balance brought down, remember we are amortizing the liability, not the asset. The lease liability was an amount of 6340. Then you are paying in advance. How much is the payment? So payment for the first year is 0. You will get 6340. 10% is 634. Balance carried down, you take the balance due, you add the interest, and this one you get 6974. The balance carried down becomes the opening balance, 6974. Then we pay in advance, and the payment is 2 million, and the balance will be 4974. When you attract an interest, will be 497.4. So you take 4974, you add the interest accrued for the year, then you get the balance carried down. I dedicated 2 hours in doing this topic, IFRS 16. 5470? 44, good. Now the question is, when we take the income statement to the P&L, What do you take to the balance sheet? So the P&L, remember I showed you how to prepare the financial statement extra. At the income statement, you are taking two items. One was the interest, and the other one was depreciation. This is the depreciation per annum. For that year, we take an amount of 1668. Now, here we are prepared for 2 years. This is the year of operation, year one. And the interest for year one will be an amount of 634. Now, let's go to the balance sheet. To the balance sheet, you need to recognize a liability. You have an current liability and a current liability. Now, for those who understood or for those who can't, whenever you're paying in advance, what do you take to the current liability? You take the balance due, and here you take the payments. And you see that a liability, this is the first year. The liability for the first year is what you're able to pay within the next one financial year, or what you'll not be able to pay within the next one financial year. So for year one, you take for year two. That's why you prepared for 2 years. So for year two, now we recognize for this 1 year, the liability will be for year two. So the current liability, you take the balance due, and the balance due will be 4974. Then to the current liability, you take the payment, an amount of 2,000. Required income statement for the year ended that 1st of December 2017. So now let's prepare the income statement. And so to prepare the income statement, now first you can copy, just copy. So now let's present the income statement. And this is Corporation Limited. The income statement for the year ended 31st of March 2016. Sharing 7,000. So we start with the sales. How much were the sales? So sales is an amount of 48,000. Then you deduct the cost of sales. Now, cost of sale, you take the opening stock, you add the purchases, you deduct the closing stock. How much was our opening stock? So inventory as at 1st of April 2015 was an amount of 18. And then you add the purchases, which was 24,600. Then you deduct the closing stock. Note number one, you're told that inventory as at that 1st of March 2016 was valued at 2.4. So you deduct the closing stock. So how much is that? So 18 minus 24, that's 6. 24 minus 6, that one you get is 24,000. So how much will be our gross profit? 48 minus 24, you get 24. Then we recognize interest income. Remember, we said that under this method, interest will be computed separately and recognized as an income. So how much of the interest income for the year? Hey, you are the one who have copied, eh? Signature footer. How much was the interest? 2,100, right? 2,100. Then you deduct the expenses. Now, for the expenses, note number 2. PPE should be depreciated at 5 million for the year ended that 1st of March 2015. We have depreciation of PPE, which was an amount of 5 million. Then you also factor in the depreciation of a leased asset. And the amount of depreciation per annum was an amount of 1668. Then there was interest expense on leased items. So interest on leased asset, an amount of 634. Then I can see there was operating expenses. Operating expenses. How much is operating expenses? So it's 16,000, you minus 2,000. And this 2,000, you are given in the last note, note number 6. Note number 6. In note number 6, you are told that included in the in operating expenses is a lease rental payment of 2 million paid at the commencement of the financial year. This rental on equipment, whose fair value is 8 million, the payment has been treated as an operating risk, or it's a finance risk. So now we're deducting these two so that we can amortize it to determine the interest and the depreciation separate. So that means that one will be an amount of 14,000. So I don't think we have any other expense. So now give me the profit. For 798. Then we prepare the statement of financial position. So this is, any question here? What's the question? Price was how much? Wanauliza how much was the sales? Kama si 48. Hey, hebu angalieni hapa. Hii ni kazi ya macho. How much have been indicated as sales in your trial balance? Hiyo ndio unauliza. Alafu nasema msiponipea naandika yenye nataka. How much is your sales in the trial balance? Sorry? 55,200. Simple as that. 55,200. So can we go to note number 4? We go to note number 4. Now in note number 4, we have the number of units sold during each quarter was follows. Can you add the total number of units sold during the year? Add the total number of units. It's an amount of 1,200. In your question paper. The total is 1,200. How much was the higher purchase selling price? Confirm from your notes. Confirm, I mean, not from your notes, from what you had copied the solution. Here nimefuta hapo. Tulikuwa tumeandika how much was the higher purchase selling price? 246. Good. Hiyo haiko kwa swali. Ninyi mmekopi. We sold 1,200 units, each at how much? Hebu sikizeni hapa, ni kama hamshikanishi. Unajua hamtaelewa kama hamu. The question is very simple. Tuliza how many units? Si 1,200. Na tumetoka kusema hapa, how much was the higher price? Ilikuwa ngapi? 46. That's why I'm saying that. Therefore, we sold 1,200 units, each at 346. Hebu chukua 1,200 times 46, mnapata ngapi? 55,200. Is that the one given in the trial balance? Yes, correct. So that means our sales was supposed to be how much? 50? 55,200. I take you back to your notes. Can you go back to your notes? Methods of accounting. Go back to the methods of accounting. Are we there? Nataka msome kenye mliandika. Under interest method. Can someone read for me? What did you write about the interest method? Under this method, sales are recognized at underline here. Then what happened? Endelea. Interest is computed separately, recognized as a what? As an income. So during the year, we sold 1,200 units. And if you multiply by the higher purchase price, which is 46, multiply by 46, you unapata the sales recognized in the trial balance, which is an amount of 55,200, right? But you say that, well, when using the interest method, the sales are not recognized at higher purchase price. The sales are recognized at cash price. How much is the cash price? Angalia note number 3, niandiko hapo. Was it 40? Yes, so here we recognize the sales at cash price. Then you compute the interest separately and you recognize it as an income. And that's what we have done here. We have recognized interest as an income. So it's 1,200, you multiply by the cash price, which is an amount of 40. So how much is that? 40, correct. Now let's prepare the statement. Any other question apart from that? Kopesha Limited. Then we prepare the statement of financial position. As at 31st of March 2016. So shillings are in thousand. So we start with the assets. And our asset, we have non-current assets where we have PPE. How much is the value of the PPE? How much are you money? It's an amount of 55, you minus depreciation of 20,000. Then you get depreciation charge for the year. Depreciation for PPE was an amount of 5,000. So 55 minus 25 get an amount of 30. Then you capitalize the right of use asset. How much was the right of use asset? 16. Munisome kenye mmekopi kenye nilikuwa nimeandika hapa. How much was the right of use asset? You are the one who has copied the workings, right? Mmekopi nini? How much was the right of use asset? 83? 83.40. Then you raise depreciation. How much was the depreciation for the past year? 6? 16. So how much would be the net book value of the right of use asset? 66.70. And go to the current assets. So to the current asset, we start with the inventory. How much is the inventory? Tafutani mkipata mniambie inventory ni ngapi? 50? It's an amount of 2,400 or 50. Now, I don't mnashikanisha kitu kweli. And we go back to note number 1. Hata msome vitu zingine. Note number 1. Are you given the closing stock? Closing stock ni ngapi? So that means kama mjui ni ngapi, kumaanisha hapa nilifanya vitu zangu. Si hapa nitoa closing stock ya 24. Njoni anapapadi tia, lakini kufika pale hamuioni. What else do we have? We have receivables. So count receivable is an amount of 34,200. Where that 4,200? Then you minus 48. Okay, this is what I mean. What are debtors? Debtors are amount that your customer owes, right? Now, this account receivable, 34,200, was recognized the trial balance based on the sales for the year. How much was the sales recognized in the trial balance? 55,200. So that means this receivable are based on these sales, what we have not received. But in our income statement, we have recognized the sales at cash price. So that means you take 55,200, you minus 48 to determine the interest element. Are you together? So you minus 48. Since this is what we have charged the debtors, but we are supposed to recognize the sales based on the cash price. You exclude the interest. So of which 48 and 55,200, the difference was that interest element. So you eliminate that interest element. So 5,200 and 48 was giving a difference of how much? All right? 7,200. So that means we have overcharged our debtors by an amount of 7,200. So we eliminate 7,200. So we get an amount of 27,000, right? Then that interest element, you recognize separately as interest receivable. But you only recognize the interest realized for the year. How much is the interest realized for the year? It's not in your notes. Was that not 2,100? Good. Do we have any cash or bank balance? We have cash at bank. And cash at bank balance was an amount of 1,800. Good. I'll give me the total. So financial capital is 53,200. You want the retained profits. So for the utility profit, in the trial balance, I don't think we don't have any. So that means you only recognize the profit for the year, which is an amount of 47.98. Then we recognize an uncurrent liability. So to the uncurrent liability, we didn't have any loan, but we have the lease obligation. How much is the lease obligation? So it's an amount of 49.74. Then we have the current liability. So to the current liability, also we have lease obligation. An amount of how much? Hata sijafuta zoezi hapa. What do you take to the balance sheet? To the non-current liability, to the current liability. So I'm just copy pasting what I had already explained earlier on how to account for them. Any other liability? So you can see there is account payable. Account payable, it's an amount of 5,000. Don't think there is anything else. So try to harmonize that. $69? 962, eh? 70. What about this? 69, 970. So you can copy now.